Hello, everyone, and welcome to another episode of Kuvera Insights, where we speak with leading industry experts to learn more about how you should manage your wealth and how you should manage the markets. Today, we have a very special guest, Mr. Manish Gunwani. He is the CIO of Equity Investments at Nippon India Mutual Fund. Manish graduated from IIT Chennai with a BTech and has a postgraduate diploma from IIM Bangalore. Um, Lots and lots of experience, 21 years of work experience in equities. He's done equity research, fund management, and now, of course, CIO of one of the largest fund houses in the country. He's co-founded a technology company in the document management space, and maybe you can throw some light on that, Manish, because that sounds really interesting. Worked at ICICI Pru. Uh, this next part is, the kind of money is managed, right? It's like $1 billion funds, $5 billion fund. Actually, he grew a fund from 1 to 5 billion in 5 years, and one of the funds grew from 50 million to $3 billion. So he knows how to manage large sums of money. So Manish, welcome to Kuvera. First of all, I think thanks for taking some time to speak to us. The first question I want to ask is, just it's a bit generic, but I think a lot of our users will find value in this. Just talk to us about your journey as a fund manager, why you chose this profession, and what excites you about fund management. You've been doing it for a very long time. You've of course been immensely successful at it. What does it take to become a successful fund manager?
Well, Gaurav, first of all, thanks for having me. Talking about my journey, I think it's very necessary to have passion for this job because it's a fairly consuming job. It consumes your mental energy, tests you a lot.
Right.
Um, so I got interested in the stock markets way back in my engineering days. I was a very bad engineer. So while I studied at IIT, by the second year, I knew this is engineering, not something.
That's Manish's
Worth
humility. Just so that I can chip in, but please
So,
carry on.
yeah. So, my family, I went through the share certificates. My father is a doctor, so he was given some free shares of those MNC pharma companies from way back in 1977 or so, right?
Wow.
And mid 90s, when I looked at these share certificates, what I found was something like 170 rupees in Glaxo, invested in 1977, had become 3 lakhs in 1992 or 93, right? And
Yeah.
it just struck me as a very easy way of making money. I thought this is this is cool, right? I mean, you don't do anything; you just buy something, sit on it. So the fascination started from there. So from that perspective, going to IIM, doing finance was natural. And I was just very lucky that I started my career right into the stock market with a firm called Prime Securities, a prominent firm at that point of time. And I started equity research, and it's just a coincidence that I've been what they call a bubble analyst because somehow whatever I researched went into bubble stage. So I started as a software analyst in the dot-com era. I started covering companies like Satyam, Infosys from 96 to 2000. All of them became 100 baggers.
You
Then,
know this question is coming, right? Which sector are you researching right now?
so that's a question a lot of people ask me because in the next cycle, I had joined Greek Securities and I started doing real estate from 2005 to 2007. And all the stocks became 10, 20 baggers in that time. You remember
Right.
DL, the biggest IPO came around that time. So I've seen a lot of extreme investment behavior. And it's been good tuition, although I don't know how many people got hurt. But yeah, it was good tuition being part of those kind of bubbles. And then I moved to the buy side because my real passion was to manage money. So equity research gave you a foundation, and I think I'm a bit of an outsider when I and landed up on the buy side because a lot of people have these 20, 30-year track record of managing money right from a very early stage in their life. I came to buy side with a bit of a different perspective. So I tend to use a lot of macro, a lot of global comparisons. A lot of fund managers, I think, are very bottom up looking just at the company or the immediate sector.
Right.
But I think it's as Charlie Munger says, it's good to have a multidisciplinary perspective in this business and
Fair
look
enough.
at it from all the way from maths to physics to spirituality. You can look at investment from different perspectives, and I think it's good to have that.
Right. No, so this is actually very very interesting because I think I 100% agree with this. I think it's a human endeavor at the end of the day, and it's not a science. We all work on spreadsheets, but that doesn't mean that those
Yeah,
models can actually predict anything. So it's good to know all the different things that can happen, but at the end of the day, it's your behavior, how you behave as an investor, how you behave as a fund manager, which probably kind of attributes the most to your success. And it is a multidisciplinary approach. There's no doubts about that. Coming to our conversation today. First of all, congratulations. One of the funds from your fund house has just completed 25 years. That's a long time for a fund to survive, and it also, I think, is one of the biggest examples of compounding in India. Right?
yeah.
For a fund to go 150x, it's not theoretical. It's not on paper. It's not an Excel model. It's not a 12% CAGR going out 100 years. This has actually happened in the last 25 years. So I think it's a very reassuring thing to be able to tell people that, hey, you know what, no, compounding is not just on paper. It happens. You just need patience. You just need perseverance. You just need to believe that things are right. So now that you have this history behind you, and how do you think going forward, right? Like the next 5 years, the next 10 years, what should an investor learn from the past 25 years that they can take away with them for the next 5 to 10 years?
So I think the biggest truths in life are very simple. And it always kind of beats me why people don't invest more in equities, because as a personal investor, obviously I've owned real estate, I've owned bank deposits, I own PF, but I just find it so easy to make money in equities because real estate, there's so much of transaction cost, there's so much of bandwidth required to manage it. FDs don't give you too much. Tax implications are quite high on these instruments. So a lot of these truths are the simple truth. Gaurav, is that even a bear will say that India's nominal GDP will grow 9-10% for next 10 years, and
Right.
and in the long term, corporate profits will be plus or minus 1 or 2% of that. And this we are talking after inflation's come down. So if you go back 20, 30 years, this is more 15, 16. But I think India has moved to a slightly lower inflation trajectory. So nominal returns and growth will fall. But the simple point is that it's fair to assume that long-term corporate profits will grow at least 10, 12%. Stock market should reflect that. Good funds will do slightly better. And where are you seeing double-digit returns in from a 10, 20-year perspective? So I think it's very easy to just say that sit on equities. I know there are a lot of cliches, like we say, time in the market is more important than timing the market. But I
Yeah.
think, as I said, the truths are very simple. I think, as you said, the growth fund illustrate that if you just sat, you got a compounding of 18-20% for 20-25 years.
Do you have any data on how many investors actually sat for 25 years?
We'll get that, but I can tell it's very low. I don't know what's your experience in your platform. What is the churn average? And I don't know if you have data on that, but obviously Manas, I guess, is one of the few who stayed around for a long period of time, but very few investors have. So
Right.
uh, that's the tragic part that we've been having this great asset class for 30 years, and we all know only 3% of households have invested in equity, 3 to 4%. So a lot of people in India have been sitting on gold, have been sitting on real estate, bank FDs, and clearly in the long term they've not been as remunerative as equity. Not just from return perspective, also in terms of the ease of owning it, the ease of managing it, the liquidity. I mean, you can sell it anytime. So especially mutual funds, I think are very good instruments from the convenience part, not only from the return part. So yeah, so you all you can tell people is that um, just look at this asset class from a 10-year perspective. It's unlikely not to be the best asset class you own because we all know with lower inflation, your bank FDs will not give you great return. Gold, real estate are not growth centric assets. So all I would say to investors of a platform is just give equities time, and once you see what it does to your net worth, I think people hopefully will stay with it.
Thanks, Manish, spending so much time with us and having this discussion with us. Fun.
Thank you. Thanks for having me.